Welcome back to Wall Street Week. We're joined today by Bill Miller. And Bill, you have plenty of ideas. People want to know how you're allocating capital. What do you want to do if you're looking long-term, 5 years out? How do you want to allocate money in this market?
Well, we're value investors, which means we're looking for things that trade at a discount to what we believe their intrinsic value is. And so our big positions right now are in things like airlines, housing, financials, and scattered tech. But there's a wide variety of names down. It's more important, I think, in this kind of market, what you want to avoid. And I think I'd want to avoid the kind of stuff I maybe mentioned earlier, which would be utilities and telecom and the stuff that are bond proxies that are perceived to be safe because we've had a 35-year bull market in bonds, which succeeded a 35-year bear market in bonds from 1946 to 1981. And I happen to believe we're probably at the end of that bull market in bonds, and the trend of rates is going to be higher, which will be very bad for those perceived safe names.
One of your names that some of your friends like Warren Buffett don't necessarily like, because they don't like technology, is Amazon. Tell our viewers why you're such a big bull on Amazon. And you've been consistently right on this stuff. Yeah,
well, probably the best investment decision I made was to buy Amazon on the IPO, and the worst decision was ever to sell any Amazon.
Wow.
So when it came public, it had a $400 million market cap, and now it's got a $360 billion.
What a score. That was so smart.
Yeah, so, well, it wasn't smart to sell it, because the Amazon position would now be bigger than the entire fund, bigger than the entire fund is. And in fact, with respect to Warren, somebody asked him the other a few weeks ago about this, and he said I can't out Bezos, in the sense that they're asking about Walmart versus Amazon. And so I think Amazon is unique in that, first of all, people have misunderstood it for most of its history, claiming that it didn't make any money when it actually just didn't report GAAP accounting profits, which is a very different thing from not making any money. But one of the things right now at Amazon, compared to great companies like Facebook and Google, for example, is that Amazon's addressable market is so much larger. I mean, Google and Facebook are fighting over the global ad market, about $500 billion. And Amazon is attacking the global retail market, which is trillions and trillions of dollars, as well as then the corporate and the enterprise computation market in the cloud, where they're by far the dominant company. So even with a $360 billion market cap, we think that's a company that can double or triple over the next 5 to 10 years.
What is the most unique thing about Jeff Bezos' management style that will enable him to execute this plan?
I'd say that he is relentlessly rational. Everything is data-driven there, and most importantly, he's got the thing focused on the right thing, which is delivering value to the customers. And one of the things that Jeff did, even with something like Amazon Prime, is start out with Amazon Prime, and then you keep giving more and more things to the Prime customers, and then you raise the price after you deliver a lot of value. And so,
Maria, you're an Amazon user?
Yeah, I am. Yeah, but what you say is really important, that it's this huge addressable market. That's the reason Walmart acquired Jet.com. They're all, scrambling to compete with Amazon.
Which, as far as I can tell, is a terrible deal. But
okay. But my question really is, a lot of the things that you're invested in are economically sensitive, right? You're talking about the airlines, you're talking about Amazon, and that's a retail play, among other plays. Does that change if, in fact, the economy does take a downturn? What if we do say a recession? Does that dictate how you're going to invest?
Well, not really, because we're not really looking to say we believe the economy is going to grow or not going to grow, and so we're not reasoning from the macro to the micro. Part of what we like to do is, we think the airlines right now are already discounting a recession. We think that industry is fundamentally and permanently changed. Now, that's a minority opinion right now, but clearly the evidence supports the fact that the company's economics are radically different from what they used to be. So we happen to believe if you had a recession equal to the recession that we had last time around, the Delta Airlines, for example, would still be profitable, which has never happened before in history.
Wow.
So what did they do? What was the unique thing?
Two things: consolidation.
Yep.
So prior to the early consolidation of Delta and Northwest, the largest market share that a domestic carrier had was around 12%, and now the top 4 carriers have 85% of the business. And so in a commodity, and airlines were the worst industry probably in the history of the world to ever try and invest in, because they're capital intensive, right? They're unionized, they're fuel intensive.
Heavily regulated.
They're heavily regulated. They have high operational and financial leverage. And so when you have, in a commodity business, so when you have that, and you have very small market shares, it's a recipe for serial bankruptcies and price wars, what we had. But now you had that consolidation. And second, the compensation systems for all the major airlines are focused on return on invested capital. That's never happened before either. So you see much more discipline in capital than you ever used to see.
What about financials? Let's talk financials for a moment, because we know that they've been hammered. Regulatory environment is going to get worse. How do you make the case to buy a financial right now?
Well, first of all, financials are a very, very broad category.
Okay, let's talk banks.
Okay, so take the big bank. We own J.P. Morgan, we own Citi, we own Bank of America. So we own the big three banks. And they've been laggards in this market. They've been laggards for several years for the reasons that you mentioned. But on a valuation basis, they are now as cheap relative to the market as they've been. And 90% of the time, then they've outperformed from those levels of valuation. And maybe even more importantly, if you take something like a J.P. Morgan, what those banks can do is they can adapt. They can use technology. They can cut their costs. So they are already, the capital positions are the strongest they've ever been. And I expect J.P. Morgan will probably continue to cut costs by about $1 billion a year for the next several years. And then flipping that over, if rates ever do go up because of the new requirements and liquidity requirements, a federal funds rate of 1% would generate $4 to $5 billion of new pre-tax profits for J.P. Morgan and Bank of America.
That's incredible.
Yeah, it's
and even if that doesn't happen, they'll raise the dividends and buy back stock every year.
That's incredible.